Hi everyone, and welcome to our web stream from the Primary Health Network. My name's Scott White. I'm the Communications Manager with the PHN. Thanks very much for joining us this evening. Before we do get started, I would like to acknowledge the traditional owners on the many lands that we're broadcasting tonight and pay my respects to elders past and present, and also give a special welcome to any Aboriginal people that are joining us this evening. So thanks very much. I will now call on our Board Director, Liz Ward, who's going to give you a bit of an introduction about what this evening is and then introduce some of our speakers. So thanks very much and enjoy the webinar.
Thank you. Hi, welcome everyone. I'm Elizabeth Ward and I'm a board member of the PHN and also a physiotherapist and hand therapist on the Central Coast. Tonight we have a timely webinar on the stimulus packages and what are available to you from two experts in the area of business and taxation. You will all have the opportunity to ask questions and we hope this webinar can be very interactive. We as a PHN would like to reassure you that there are people here who are listening to your needs and working passionately for you behind the scenes. Next week we will be bringing you two further webinars, one on Wednesday on the practicalities around telehealth, and there are some great developments in this space regarding a free health-based video platform that is secure and can be used in general practice as well as allied health, and so tune in for that one. We have a second webinar on Thursday, the 16th of April on HR and your responsibilities in the workplace. Just log on to the HNECC PHN website to register for either of these webinars. I know a lot has been happening lately in the PHN in connection with general practice, and more recently the PHN has also started to focus on the needs of allied health practitioners who we recognise are also struggling in this new time of COVID-19, particularly around business continuity, legal issues, the rules around the requirements for PPE with face-to-face consultations, and of course telehealth. We just want you to know that we're onto it as a PHN, so watch out for relevant articles on these topics in our upcoming COVID-19 bulletins. Now, just to introduce our speakers for this evening, our first speaker is Andrew Beattie. Andrew is a director and partner of PKF Accountants and Business Advisors who leads the Newcastle Business Advisory Services and Corporate Finance teams. And our second speaker is Darren Shon. Darren is the Newcastle-based tax partner for PKF and has been in that specialist role for over 15 years and has been in public practice for over 30 years. I would also like to thank PKF and our speakers for volunteering their time for this event. I'm glad they can bring their significant expertise to distilling the key points relevant to us from this complex legislation. Over to you, Andrew.
Thanks, Liz, and thanks everyone for joining us, I guess, and the opportunity to try and put some simplicity, if you can call it that, around some of the things that have been hitting us from a legislation point of view and a cash flow point of view in the last couple of weeks. From our point of view, we've never dealt with so much inquiry. We couldn't have predicted how fast COVID-19 has affected the business landscape and the general market. We don't plan to go into too much detail around that and people's opinions. What we're here to do is try to help you navigate and make sense of some of the things that have been coming through in the stimulus package, what you can access from a bank, and also getting your things in your affairs in order from a point of view of cash flow. We don't want to bombard you with slides. We've kept this pretty simple from a slide point of view and want to talk to a few of the key points. What I will start with, we've heard some key concepts or catch cries from ScoMo, the Prime Minister, over the last couple of weeks, being the other side, being we're all in this together. And that's entirely true. And a lot of the stuff we've been talking to clients about is really that this will have a period that we need to get through. There will be another side, and that's what we've got to work towards. And I think the other thing I wanted to start with from a catch cry from ourselves is cash is king. You know, it's a concept in business we talk about a lot. Sometimes it gets overlooked when things are normal, but in the environment we're in at the moment, it absolutely holds true. And that's what we want to focus on, of how you can use that to survive through this period and be ready for the bounce back. There is a lot of detail. You know, there's been a lot coming thick and fast, and we're trying to keep up with it. There's also a lot of misinformation out there, you know, and I can't blame anyone for that. People are trying to comprehend this, but there's opinions, there's information that hasn't necessarily been finalised yet. For instance, the JobKeeper, which we'll talk about, the framework got approved last night. The rules are still with Treasury. They're not actually finalised yet, which Darren will probably talk about that in a minute. What we do want to make sure is if you do have a question, please put it through. We'll try to do our best to answer. If we don't get to that question, the following days we'll have more information coming out as this stuff comes to light, and we can get accuracy around some of these rules. It's important, but you do look at legitimate sources for what you're trying to take away from this and make sure it is correct. So I'll move on to our first slide, which jumps straight in and talks to the stimulus package with more of a focus on the Australian Taxation Office and some of the things you can do immediately around this. There are many things you can do within business. That isn't our focus tonight. You'll see by the slide we've really tried to bring it back to pragmatic things to get your head around from the stimulus package. With that, I'll pass to Darren to start with the PAYG withholding.
So the PAYG withholding, is the other name for it, is the cash flow boost. It is a cash flow boost, but it doesn't necessarily mean that you'll get cash. What it's talking about is the withholding on people's wages, so you've still got to pay wages and withhold tax, is that you get to retain that in your business and not have to pay it across. So there is a limit, and it's up to $50,000, and there's a minimum of $10,000. But it's on the basis that you're employing and withholding tax.
I think the key thing on that is that you're still paying people, okay? All of these and a lot of these incentives have been about keeping people in the workforce. So, if we're not paying wages and therefore not withholding, that part doesn't apply.
Yeah. Now there is a second boost, and it's exactly equal to the first boost. So whatever you get in the first period, and it varies whether you're monthly or quarterly as to how you measure it. There's a bit of detail there. That'll set what you get, and then you get the same again, and the payments are staggered based on that over time. Now, there's nothing you have to do for this other than just continue to pay and just continue to withhold. It gets measured off your BAS. There are turnover thresholds that you need to be wary of, and there is some discretion in that. If you were close to it in the prior year's tax return, that you can talk to the ATO and see if they will assess you in. But in the first cut, you just lodge your March BAS, whether that's quarterly or from monthly, and they will determine what the amount of the credit is.
I don't know the size of most of the people online here with regard to turnover. The turnover for most small businesses will be fine because this is a $50 million turnover test. There are many clients that we deal with, but that do have to take into account what trade was like last year because it is measured off FY19. We're now 3/4 of the way through FY20, so that does need to be taken into account.
Now, and there are lots of rules and lots of concessions where you can work around there. In all of these laws that we're talking about, they're given broad discretion to make policy change on the run, and for the tax office to have a wide discretion to actually do some administrative stuff to make this all work. So, but for the first bit with the pay-as-you-go withholding or cash flow boost, just do what you're normally doing, lodge your BAS, it's the only paperwork you need, see what comes back, talk to your advisor about checking it to make sure it meets your expectation and go from there.
I think another aspect of that one that Darren hit on, and a lot of people, given the situation we find ourselves with and the upheaval to day-to-day life, are thinking, well, lodgements of things like activity statements are the last thing on my mind. You only qualify for a lot of these stimulus incentives if you keep your lodgements up to date. That one in particular, you actually have to lodge to get the rebate. And the other thing I want to reiterate, a lot of people thought, that's $50,000 coming into my pocket. Well, it's already in your pocket, okay? You just don't have to pay it out. It's been a common mistake we've dealt with over the last couple of weeks. You don't want to be building that into your cash flow as additional incoming funds. It's just less going out.
Now, in terms of actual cash, the first boost will not be additional cash. It's just the tax that you've withheld that you don't have to pay on. The employees still get the benefit of the withheld tax, but so the government's basically leaving that with the employer, and it's non-taxable. So it's a free hit to the business. If that employer after June stops employing and doesn't withhold tax anymore, they get the second boost the same as the first boost. So that's really only where they're going to get cash out of it. If they're continuing to employ at the same level and withhold the same amount, or they're withholding above the limits of $50,000 per period, they won't actually get any cash. They won't have to pay it across as withholding.
What about, Darren, if there's already a balance outstanding with the ATO from an employer?
It will go to their integrated account, but it's not designed to offset income tax or other liabilities. So you'll still have GST on that BAS as well, so it'll reduce the GST. So the GST you're collecting from your customers, if you're charging GST, you'll get to keep, but with a lot of health, there is no GST.
I think the key message is making sure you are getting this right and you get advice around this, because you need to get your lodgement in to actually see the benefit for your longer term cash flow.
And if we go back, cash is king, so you need to understand how the cash flow is going to impact on your business.
That one's probably the easy one to actually attack. We might move to PAYG instalments, which is the prepayment of income tax, if you like, from a business point of view or individual. So do you want to attack that one? Yeah,
this one's a little bit tricky because it's not legislation, it's not in the stimulus package. This is actually an administrative concession that the ATO have offered, and they've offered a whole range of stuff. And if you go to the ATO's website or search in Google ATO COVID ID, all of this assistance will come up, and it'll take you through a lot of the measures, but it'll show you their specific assistance on instalments and tax. So what they're offering is a deferral till September of tax bills. So a 6-month deferral on tax, so that's actual income tax. So it doesn't mean that you don't pay the tax, it means you don't have to pay it till September. Now, it will accrue interest, but at a low rate. If you're lucky, you can negotiate no interest. The other thing they're allowing is that most people, when they're earning income and they're not employees, are paying tax by instalments. So they will have already paid the September and December instalment, and they're coming up with their March activity statements, and they're going to be hit with another instalment there, and then there'll be the June instalment. What they're allowing you to do is to vary that March instalment to 0.
Just on that is actually something you need to do in your activity statement. So we said with the first one, the PAYG withholding, you just need to lodge and the ATO will deal with the rest of it. On the PAYG instalment, you actually need to vary your activity statement. So if you have advice around this, make sure that is being done. If you're doing it yourself, make sure you understand where to do that. There's codes to be able to do that.
Now, the other part of that is they will allow you to get a refund of the September and December instalments that you've already paid. But you need to specify the credit for those, because if you don't add that in the variation form, you won't get those back.
Yeah, again, that's something you have to do. And I think, again, we'll keep coming back to this cash is king. Why would you want to get a variation or a credit based on tax you've already paid? Remembering this is prepaying for the 2020, the year we're in, the tax that will be due later on. We're taking the view if you need cash in your cash flow, in your business to keep surviving and to keep employing people, etc., you're pulling that cash back from prior periods that you've already paid.
Now, by varying the rate to 0, the June instalment will also be 0. So there won't be an outlay there. But it doesn't mean that you won't have a tax bill when your tax return is calculated and lodged that will be due. The instalment's less than the amount you've got to pay on assessment. The assessment will be the full amount. So you've got to plan for that and be prepared that you will pay that tax.
I think that's just on that point. That's a really good one. A lot of the stuff we're talking about, I mean, there are some direct stimulus measures by the government, but a lot of the things we'll get to, like tax instalments, that'll be dependent on where you finish from a profitability point of view, obviously at the end of the year. Like the bank stuff we'll get to in a minute. A lot of these things are just kicking it down the road, if you like. It's not full relief. It'll be dependent upon your circumstances. It's deferment in many cases. So you do need to plan for that.
But if your income has taken a hit, of course you won't be paying as much tax. So it won't make such a big difference if you've got your instalments back, because the tax bill will be lower. But most of these measures are aimed at getting everybody till tomorrow. They're not about getting everybody past December. It's to get you through this initial period so that you can survive on the other side, and then things will start returning to normal and you'll start making money, and the money will be there to pay the taxes. And then you can look at further payment arrangements when those taxes become due. And a lot of the income tax won't be due until this time or later next year for the current financial year that we're in.
Hopefully people are back trading properly by then and have the ability to fund and take care of these kind of things. And that's the intent.
Yeah.
Okay.
And don't forget the income tax instalments. Talking about payment plans, if you still want to pay, some of my clients know that they're going to pay it, and they know that if they're given all of the money now, it's like anything, they'll spend it. So they're still chipping away at their tax bills to make sure that they don't get a big surprise or a big deficit then. If everything goes really, really bad by September and you can't pay a tax bill, there are reliefs from paying primary tax. It's very hard to get. It's a long process, but it does happen in genuine cases of financial hardship if everything falls apart, particularly for individuals. Rather than face bankruptcy, then there is scope for some administrative relief.
So just reiterating, on the PYG instalments, there are actually steps you need to take when you are lodging this. Again, if you're unsure, there's plenty available online around this. Drop us an email by all means, or speak with your advisor. It's probably the best way to look at this. We've assumed there wouldn't be many people in this call with apprentices, but we assume there also may be some with trainees. So there is a smaller one that's not a lot in it, but it's still available for people with trainees around a stimulus and covering wages.
Yeah, so it's up to 50% of wages, and there's a maximum of $21,000 or $7,000 a quarter. This is something that you will actually have to go through a assessment process with. It's not like the first one where you just lodge your BAS. It's a bit different to the pay-as-you-go instalments where you've got to vary it. You've actually got to be assessed by an AASN provider, and the trainees have got to be signed up through that program. So it's only for employers with less than 20 full-time staff who have a trainee and meet other conditions like that. But you will go through a formal assessment process. They'll tick it and say, yes, you're approved, and then you'll get the subsidy that way.
The next one, the instant asset write-off, we've put it in there because not everyone isn't looking to spend money. And what I'm saying by that is if we've already had planned in place to buy a piece of equipment and it's required for future income generation, etc., and there can be some decent sized piece of equipment with decent cost around it. Instant asset write-off has been something put in the government, again, to stimulate the economy, but up to $150,000 of instant asset write-off between the last quarter there in the 2020 financial years. You want to talk a bit more about that one?
Yeah, so the interesting one with this is the threshold. If you look at the measures, the first pay-as-you-go measure had a $50 million threshold. This one has a $500 million threshold to access this write-off, which was $50 million before the package was announced. The JobKeeper has a $1 billion threshold for a 30% reduction in turnover versus 50%. So it's sitting in the middle. 500 million is a lot of money. So it's going to expand that. And the idea with that is that the companies that might make the equipment that you want to buy, if they're less than 500 million, they'll invest in that capacity to build the machines if you're buying them as well. So it has a flow-on effect. But the point of it is that it'll give you that if you're going to spend that cash and you've got it available, you were going to buy a machine or there's a machine you need to buy to provide services. It could be computers, it could be stuff to help with your telehealth or communication equipment, something that's expensive, more than 30,000 it may be, you'll get to write it off. And if you buy a number of items like 4 conveyor belts, I know that's not a health thing, but the examples they give, you get it for each conveyor belt. They don't aggregate them as one purchase because you bought 4 at once. Yeah,
look, we're going to be talking about cash flow and planning for cash flow shortly, but we've mentioned cash is king. So obviously if you don't need something, we wouldn't be recommending going out just to get this write-off. That's not the intent, I guess, here. It is trying to encourage, if there was something you're thinking about in the coming months and cash flow permits, it is a good opportunity to take that up. There is a limit on cars.
Yeah, so it won't apply to ordinary motor vehicles, much to the Mercedes dealers' demise. He doesn't like that, but that car limit of $57,000 will still apply. So you can't use it for cars, but you can use it for anything else. It's important because your tax bill is basically money in, money out, okay? And certain things you don't get a tax deduction for, so money out. So you might have made $200,000 but spent $200,000 on plant and equipment. You're going to still get taxed on $200,000, and the write-off for the equipment's only going to be a percentage over time depending on that. This will make it so that there's no taxable income or reduce it. So it's going to increase your tax bill in future years because you haven't got future write-offs on the plant, but you're getting it all now. So that's why you would invest in it. And I've got plenty of clients who are doing that, who are deciding now is the time to buy that new machine to do things better, so that when we come through this, we're ready to go.
And this all comes back to planning, okay? This slide focuses very much, and the section we're in focuses very much on the stimulus in isolation. But as I said, when we get to start planning around your cash flow, if it permits, this could be a very good initiative, not necessarily to the 150, but whatever it needs to occur, so that going forward, you are ready when you can get back into trade to maybe have a leg up against someone else or a competitor, etc. So you really need to think what opportunities this could create. Of course, if the cash isn't there, it's not something we'd be going to look at, unless you then start to talk to your banks, and we'll get to banks in a minute.
Now just remember too that this is time limited. So it only applies to the 30th of June. As of the 30th of June, the current laws drop that threshold down to $1,000 for an instant write-off. So, and it is less than 150. If something costs you exactly 150, it doesn't qualify. It has to be basically $1 less, or it could be a cent less, but let's just go with $1 less for simplicity. Yeah, so it has to be done by 30th of June. That doesn't mean ordered by 30th of June, that means bought and installed by the 30th of June and up and running so that you can write it off. Yep. Now there is another side to that too, and that's another write-off. So for assets that don't qualify for that full instant asset write-off, i.e. a luxury car and things like that, then there is another mechanism where you can do a 50% deduction and then normal depreciation over time. Still would be limited to the depreciation cost limit for that car, but it's another measure where you can claim some accelerated depreciation on equipment. But that's mainly for the bigger players who are spending more than the 150.
There might be some expensive equipment. Yeah, in GP practices, which are large GP practices, that might be buying radiology equipment.
Yes, exactly right.
That's right.
Yeah.
And the thing we really need to keep encouraging is there's so much doom and gloom, and a good reason for. And everyone's thinking about how do I survive, but there are many cases we've got to be thinking longer term. I mean, a lot of the stimulus is around 6 months. A lot of the bank packages are 3 to 6 months. We need to be looking further than this, because whilst we might be in a partial lockdown or shutdown position, and that's having an effect on trade, you've still got to work out how you keep going after this and put yourself in the best foot forward. So it's a bit of a balancing act.
And I think we've seen a lot of businesses really think about what they offer and how they offer it, and they're realising that they don't need to have people in an office to run their business. They can have them running from home, which means investment in resources and assets in those people's homes to do that. And there's new opportunities, like people are now delivering when they weren't delivering before, and they're going, well, why weren't we doing this before? The government with their telehealth and 10 years worth of work in 10 days, I think they keep quoting, well, they got incentive to do stuff. So that equipment and that spend and that deduction might be something that you've always thought about doing, and you do it now where you get the incentive. So they're on the other side of this, you're up and ready to go with a new income stream.
The innovation we've seen in the last 2 weeks is unbelievable. It's wonder what pressure does, but
And it's forcing people kicking and screaming to operate in new ways that they haven't operated in before.
That's right.
Yeah.
The big one, point 5 on our slide here around JobKeeper payments. Now, I said at the start, and I will say again, Parliament approved last night the framework. They've thrown it back to Treasury to really define some of the rules. We have seen some sneaky draft rules, if you like, and there are still some questions in there even from us. So we will talk to what we know. It is quite complex given where there's a straight payment being made and annual leave, etc., etc. There was also fair work changes, temporary fair work changes that came out last night as well. So again, we'll keep this as simple as we can. I'm sure there'll be questions later about it, some which we can answer, some which we can't. But we will have more information in coming days, I'm sure, so we can put that out. But Darren, do you want to take the lead on this one? Yeah,
so the 2 key elements of the JobKeeper payment are that it's or 3 actually, it's a safety net. So it's designed to give every employee that's continued to be engaged a minimum benefit of $1,500 a fortnight, which is about $400 a fortnight more than the job seeker payment. So it's an incentive for employees to stay engaged with their employer, get more money, and be there on the other side. It does mean that you still got to pay the wages to the employees, and being a minimum safety net, you have to pay them at least $1,500 a fortnight, even if they weren't earning that before.
So the common example there, and we've had it time and time again the last 2 weeks, or a week and a half since this has been announced. If someone's getting paid $500 a fortnight, they might be casual, doing a few hours here and there. If they've met the rules, then it'll be brought up to $1,500. You know, a lot of people are struggling to get their head around that. Now, this is an arrears payment as well. So employers need to fund that gap. And that's what you're going to need to really have a think about with your cash flow.
Now, you don't have to take every employee, but you would consider all those that are eligible, particularly if you're in a stand-down situation where nobody's getting paid, because you're going to find the money to pay them the $1,500 a fortnight and the government's going to give you that money back. So you want to be pretty certain that you're going to qualify. Most people have been a bit hesitant to actually sign up and start paying people, particularly where they're stood down yet, until they see the rules, and they still haven't seen the detailed rules. The Treasury fact sheets are, and if you know where they are, they're just on the Treasury website.
It's treasury.gov.au.
Yep. They're pretty accurate. They've been evolving every day since the 30th of March, and if you miss a day, you've missed an update. So you've got to look at it again, and they pretty much spell out what these final rules that we've seen in draft look like. The rules imply that you have to pay your employees every fortnight, but there is a concession if you are on a monthly payroll that you can allocate those to those fortnightly periods, and the fortnights start on Monday, so Monday 30th of March to Sunday the 12th of April, and so on. It flows.
Yeah, the government whole initiative around this, and it's probably, for obvious reasons, it's been probably the most sought after initiative from everyone we've been speaking to. How do we qualify? But the government's initiative here is to try and intent is to try and keep people employed. They do want the economy to bounce back. So, but it is an arrears payment. So you need to look at your numbers and look at how much you're funding in the short term, being a month. Their intent is also not to change your payment methods or frequency just to help with cash flow. So if you've been used to paying people weekly, their intent is not for you to now go and pay monthly, so you're only carrying it for a very few days until you get paid in May. So the key dates here is people had to be employed, either part-time or full-time, I'll come to casuals in a minute, on the 1st of March, okay? And the payments at that $1,500 level have to start from the 30th of March, okay? So realistically, you're funding the month of April, and the intent is that the reimbursement from the government will come in the first week of May. That's to our knowledge at the moment. Casuals?
Yep.
12 months?
Yeah, so that's a casual will only qualify where they're a long-term casual, which means they're being employed continuously for 12 months. Now, there are some little quirks in that. Some of the examples I've seen are people who are currently casual but have been employed in various roles throughout that organisation, and they've been with that employer for 12 months. They will still qualify. The casual rule talks about casual on the 1st of March. So if they're full-time on the 1st of March, then they're under the full-time rule. It doesn't matter that they started on the 1st of March or the day before, they will qualify because they're full-time or part-time on that day. If there's been an acquisition of a business and you're recognising the continued service of that person for another business that was owned by somebody else, then that will continue as well. So it's normal continuity of start date and everything, that normal commercial rules will apply.
They've also indicated if you're in a group of companies and someone's moved between companies,
yep,
there'll be some concessions made, but as it stands right now, it's meant to be entity-based, so we're waiting to see what comes out around that.
Yeah. Now, most of the payments will be recorded through your single touch payroll, and so the process will be automated. So when the registrations finally come out, those using single touch payroll, which should be pretty much everybody except micro employers.
Just on that, if people don't have single touch payroll, if you're on Xero, MyOb, a lot of these systems, they were upgraded for single touch payroll earlier in the year or late last year. So it should be already in play for most of you.
So as you pay through single touch payroll, the government will already know who you've paid and how much you've paid them, and they'll also know the registration process will pre-fill with the details you've already got in single touch payroll that you can check when you do your registration. The registration isn't out yet, given that the framework was only just passed. We're expecting that shortly, but the steps are the employer will assess their eligibility. So the third key factor that I was mentioning at the start is the turnover drop. Now, I'm pretty sure everyone will be less than $1 billion, so it'll be a 30% drop in turnover. Now, the drop is based on your GST turnover, so it would be your GST-free supplies and your taxable supplies, but it won't include any input tax supplies, which you probably won't have anyway. But they'll look at it based on BASs, so they'll know what your BASs were like for the period last year, but they want you to project turnover for the next month. So they want you to get an idea, but if you're quarterly, they want you to predict for the quarter and compare that to the same time last year. But then the ATO will have some concessions to do that. And if it's 30% and you end up at 28, probably going to let it slide. But we'll have to wait and see how tough they get. But they're not going to be draconian on this, because eventually they expect to go down. A conversation I had with one employer today was, I want to get the JobKeeper payment, but I'm actually making more money than I was making before. I'm sorry, you just don't qualify.
That's been coming up quite regularly. That's been coming up a lot from people that we've been referred and fielded queries from. Let's face it, this is to keep people employed and business surviving. You know, if you have the ability to invoice and have the ability to collect real cash, that's what you should be doing. Your business is going to be in a much better state anyway. So forget the stimulus, that's just good business practice. If you're starting to play with things here just to qualify for a JobKeeper payments, you know, it's not quite the intent, and it's probably not a good practice in business either. But, you know, this isn't going to be a perfect model for everyone. And they've rushed through legislation that would take months, if not, you know, years, in the space of a few days and a week. So there are holes in it, but it is designed for the people really affected who have dropped significant turnover to be able to apply this to keep people employed. And it will catch the majority.
Yeah. One thing you haven't addressed is the partial stand down. So if you've got practices that have had a 50% downturn, they've stood down some of their employees and they've only partially stood down others. So they've reduced from full-time hours to 3 days a week. How do you top up? What is it, a top up of their wages on top of that?
It's a choice for the employer.
Right.
So as I said at the start, it's a safety net, $1,500 a fortnight minimum. If somebody's already earning above that, you don't have to change that. You can keep them at that level. So if it's $2,000 a fortnight, they can stay at that. As an employer, you can choose to top them up with the JobKeeper payment if you want to, and it's up to you how much you top them up, but you don't have to give them more than what you're paying them. Even if they were on $3,000 a fortnight and now they're on $2,000, they only need to get the $2,000. That's a negotiation for you to have.
I think the key thing here is the government saying, we'll fund up to this amount, you need to pay people a minimum of this amount. In reality, you still need your cash flow modelling, you still need your planning in place to know what can I afford. Like obviously if we're bringing people down from what they regularly earn, they would prefer to earn what they regularly earn, but the business needs to still survive. So the government's come and said, we'll fund it to this point. And so to your question, and there's a myriad of different examples there, there'll be people that actually do better out of this. You know, there'll be people that earn less than $1,500 a fortnight that we're now being told we have to lift them to $1,500 a fortnight. You know, I've had a few people tell me with that, oh, can we just pay them what they usually earn, the lesser amount? And the answer is no. We need to be lifting these people to $1,500. I've been advising clients, I'm saying what you've got to be aware of is, what about when the stimulus is over? People get used to what they earn pretty quickly. If you want to drop someone back, you better have them prepared for that, because now they're going to be earning more than what they usually would.
And on similar vein, there are complications with people who are on leave. And then it gets a bit messy, and this is where you sort of need some employment law related advice with all the Fair Work Act changes that actually came through in the same set of bills. is that they had to make some wholesale changes to allow for work practices to change, to allow for JobKeeper and to allow for these things to occur. We're only just getting our heads around that now, and we're not employment lawyers, so we're being directed around that. But Andrew and I had a conversation today just about if people are on leave, how do you work out the leave? If they're on half pay leave, how does that work with their entitlements? How do you account that? Common sense would be that if they're on half pay leave, they're only taking half the hours of leave as paid leave and the other half is unpaid leave. But
This is undirected at the moment.
this is undirected. So,
And what about the accounting programs, the wages programs such as Xero and wages windows? Are they actually rewriting rules around this?
We have not. Well, to be fair, we tried to ring Xero the other day on a completely different matter and we just could not get through.
Right.
So, I think they're dealing with people trying to put subscriptions on hold, that's the reality. But I wouldn't think they can react that fast. These programs are pretty sophisticated, but this legislation is wholesale and it's changed so quickly. And remember, it's only changing for a 6-month window maximum. Okay, that's the other thing to note. This is intended to start for the month of April, so it's a maximum of 6 months from 30 March. But if you don't qualify until April or May, well, the window gets less and less.
yeah. And so it is a monthly thing. So if you don't qualify in April, but you qualify in May, then you get it for May, and so on.
The other aspect of that is, what if you qualify in April or May, and then for some reason you don't qualify in June? Again, that funding thing comes up again. How do you fund what you've just put your new rates for your employees on? So I can't stress enough, you can't look at this just in isolation. It needs to be part of a full model for yourself and a bit of planning, because it is pretty complex, and when you're moving employees around that have also got to make calls on their livelihoods, you really need to get your head around what your business can and can't afford. So Darren is right. The only thing you're obliged to do is make sure people are paid that $1,500. Anything above that, or if you want to top them up, etc., that'll really come down to your modelling and the commercial call.
Yeah. And the leap of faith, the main conversation I've had today is, we don't know if we're going to qualify for April, one of the people I was talking to, but we've got to pay these people $1,500 and they only earn $500 now. What happens if we don't get it? Can we get the money back? Probably not. You've already paid the person. So there is a whole series of considerations about overpayment of wages and employee agreements and being able to claw it back. It's an employment lawyer thing. It is possible, but you need to make the agreement with them now. So I think that person is going to get some employment law advice, but going to have an agreement is that I'm paying you this because it's the stimulus, it's the JobKeeper payment, but if I don't get it, I need it back, so I don't spend it.
I think the key thing, just to add to that, and even from, as late as this afternoon, we're having this conversation with a client, it's very important with employees that you've got a bit of transparency there. Generally, if everyone does understand what we said at the start, that concept about we're all in this together. There's been measures put in place for employees as well, around they can go for mortgage relief, this sort of stuff, and they can access super, etc. I mean, we've kept this more about the business, but if you're having transparent conversations and we're all in this as to how we get through it, so we're better on the other side, whilst it might be legislated that you can do this and that, it's at least something that can be considered, and we can wait for further rules to see if there's any concessions around some of these things. Okay, so it is a conversation to include people in.
One big issue in health particularly is there's a lot of surge workforce planning occurring in public health. So we've been encouraging a lot of employees to apply for those casual pools at the public hospitals. So what happens if they then get some shifts at the public hospital in relation to that JobKeeper?
They can only get JobKeeper from one employer, and they register with that employer, and generally that's going to be the employer that they take the tax-free threshold from. So if they've got a second job at a hospital, they won't be taking that tax-free threshold. So prima facie, that employer is not eligible for it. But they only get one, and they get nominated by their current employer, and then they acknowledge that. So they're saying, I'm linked with you, I'm not linked with someone else. So they can't get it from somewhere else. They're allowed to earn income. They can have 10 jobs if they want, 10 casual jobs and one full-time job, but the full-time job or the more permanent job is the one they'll get the JobKeeper payment through.
And it's a good point that a lot of people have missed this one too. The JobKeeper payments, when they are paid out to employees, are taxable.
Yeah. So they're taxable to the employer and they're taxable to the employee, but because the employer is getting $1,500 and is paid $1,500, it'll cancel it out. But if there's tax to be withheld on the JobKeeper payment, because they probably will at $1,500 a fortnight, then the employer has to withhold that and pay the after-tax amount. You'll see the fact sheets talk about a before-tax amount of $1,500 a fortnight. Right, so they're implying that it's taxable in that manner. But then you would couple it with the pay-as-you-go withholding or cash flow boost and not actually have to pay that pay-as-you-go withholding over and get to keep that if you're in that $50 million threshold.
So I don't mean to put a dampener on this, because it is a great initiative and it will help a lot of businesses, but you still have to do a fair bit of administration around this JobKeeper payment. So you will need people to still run payroll. You know, you'll need to put your activity statements in, etc., etc. So it's not just a flow through.
Yeah.
There is work to do, and that's where you really need, again, comes back to your planning, especially with the increased job seeker, which is equivalent of the New Start, if you like. In some instances, if businesses have been pretty much reduced to zero revenue, it may be better in some instances still to put people on stand-downs or redundancies and look at the job seeker as opposed to the JobKeeper payment. So this comes back to your individual planning. The other aspect on the JobKeeper payment, there is superannuation payable on the normal portion.
Yeah, so in the example that we had before, somebody who's on $2,000 a fortnight, there would still be super on that payment because you're paying them $2,000. It doesn't matter that you're getting $1,500 a fortnight from the government, you've agreed to pay them $2,000. The person who's getting $1,000, who you've got to top up to $1,500, you only have to pay the super on the $1,000. Right? Because that's what you were already agreeing to pay them, so the super still applies to that. The person who's still down, who's on zero, who you're now paying $1,500, you don't have to pay super on any of that because the entire amount they're getting is the job seeker boost. If somebody was on $2,000 and you decided to give them the $1,500 and take them to $3,500 a fortnight, you would only have to pay it on the two because the $1,500 is an extra amount that you're paying them. So there's no super on that if that's additional to what they'd normally earn. And
we'll have some more fact sheets coming out in this from our firm as well in coming days. I'll give you an email at the end if you want to access those because it's fairly complex. We're going through this fairly quickly, but we're trying to get through a fair bit of information.
Yeah, just like the telehealth thing with 10 years worth of work in 10 days. Normally with laws like this, there's drafts, there's a period of review, professional bodies get to comment, the opposition and the other parties get to comment and review it, and they model it, and it doesn't just sail through. Like pretty much all the amendments that got proposed last night just got shot down, even though they started at 10 and finished way after 9:30, and just debating it, it didn't change. And that's rare. That just doesn't happen.
Just to touch on, we haven't had a lot of direction around payroll tax or workers' compensation insurance on these payments, but we're assuming they would apply. But again, we haven't had
state government-based taxes, so we need some direction from the state governments there. We expect them to be included, but then you've got the state government concessions that we'll talk about in a little bit, where the 25% discount in New South Wales might apply in other states. So we need to keep our eye on that.
Probably in the interest of time, the final point on the JobKeeper payments is at the moment there's an expression of interest or to register your interest on the ATO's website. If you haven't done that, at the very least to make sure you do get further information, qualify on there with the registration process. There will be a further registration, a more in-depth registration process come through, we're told, but we still don't have a lot of info around that. And there'll be a commissioner's discretion, which we referred to before. Do you want to quickly touch on that?
Yeah, so we're looking for guidance. We don't have that yet, but the Commissioner has administration of this scheme, and the Commissioner can make some administrative concessions and in the various matters, and we're waiting to see what that is. So.
Yeah, because at the moment, as we said, they'll be comparing March versus last March, April versus last April. That's been the guidance we've received. We're saying, well, that won't reflect true earnings of the current standard of some businesses if they've been growing, if they've acquired businesses, etc., etc. So. Again, get your planning, get your forecasting in, show where your current trade is to where what your trade was compared to where it is at the moment in the last few weeks. That's going to be your best tool should this come up and you can have an alternate testing.
And just one final point, all of these measures, particularly 1 and 5, have deliberate measures in them. So normally in the Tax Act you have a general anti-avoidance provision and it sits over here and it governs the whole Act. And you have the laws and they don't mention anything about anti-avoidance. These laws actually have anti-avoidance written into them. If they think that you've done this just to get the pay-as-you-go withholding cash boost, and you've deliberately put people on just to get it, or up their wages and their withholding just to get it, or if you've deliberately done something to get enhanced JobKeeper payments, they will strike it down, they will audit it because they'll have a pretty strong electronic trail. And they, in the JobKeeper, there's actually a mechanism for joint and several liability. They'll chase the employer and the employee for the repayment of the amount.
And that, not that they've said anything in too much detail yet, but there will be a lot of policing eventually around this.
Yeah.
You know, from tax agents have been warned, employers have been warned. So, you know, in the spirit of it, the intent is to get more businesses through, and that's the way it should be applied.
Yeah. And just one other final point on JobKeeper, which is the late change. It happened on Sunday, is that for the smaller doctors, general practitioners who might have incorporated, but might take all of their wages out of that company as like deemed income or dividends and the like. Mm-hmm. So they're not actually employing anybody, but it's them trading through a company. They can actually apply for the JobKeeper directly into their bank account. And if they are employing people, but they're not taking a wage per se, then they can still apply for that $1,500 for them, as well as getting it for the employees per fortnight as well. So that's something to consider.
And I did hear that in partnerships, only one partner can apply for the JobKeeper.
Yes, that's right.
That is trusts only one beneficiary.
Yeah, unless they're employees, they can have employees.
Yeah.
But if two partners, yes, it's
only one partner of the two can get the JobKeeper.
And if the company might have 10 shareholders, only one. That's a shareholder director can apply for it if they're not an employee drawing wages. But that company, they could be on the payroll taking wages, in which case they fall into the JobKeeper.
Right.
We probably still haven't covered everything in that aspect, but we've spent a lot of time on the stimulus, which was the brief. So we've got a few more slides just to whip through that still need to be taken into account, are very important for your own planning. So we'll get to those now. We're focused on the New South Wales state base. We're assuming most people here would be covered by that. Darren, you want to talk about the payroll tax?
Yeah, so in New South Wales, you still lodge your payroll tax if it applies. You don't have to pay March, April and May. When you do your June reconciliation, it'll come up with a payable amount, presumably, and then they'll take 25% of that off, and then there'll be a square up, either a refund or a payment based on that at that point in time. And they're bringing the threshold up, so it will rise to $1 million in payroll a year or two earlier than it was going to.
We've got the state-based small business grant. This was announced only in the last few days, I think Friday actually, by the New South Wales government. I believe it's the 17th of April, thereabouts, that you can apply for this. Again, it's via their website, I'm told.
Service New South Wales, you'll apply for it, and it's up to $10,000. It's a pretty narrow band of employers. I think they've got to turn over more than $75,000, but below the payroll tax threshold. I think there's a number of employees measure as well, but it's a $10,000 grant that they will get. It's similar to something they were doing in the bushfires. So they know it works, and they know they can deliver it, and they can know that they do it effectively. So they're offering that. They said on Friday, within the next 2 weeks, you'll be able to apply at Service New South Wales.
So anyone who pays payroll tax currently doesn't qualify?
No. If they're above the threshold, they don't get this. This is just for the businesses that are above 75 or below, like 900 currently.
Yeah. And with that payroll tax one too, practically, just to reiterate, you still need to lodge that every month. You just don't pay March, April and May. And then at the end of the year, they'll do the reconciliation to square it all up. Okay, so the lodgements, the theme here, whether it be the ATO or the OSR, etc., the lodgements still need to occur. Okay. This one's had a lot of, the rent and lease had a lot of exposure and a lot of media the last few days. So a couple of weeks ago, the government came out and said there'll be a moratorium on evictions for the next 6 months from a commercial leasehold point of view. Only the day before yesterday, they came out and the rules were a bit more finite yesterday around a commercial lease. And basically landlords have to come in and negotiate with you now. So people that qualify under this, the code, they're calling it, is that if you qualify for the JobKeeper, you will qualify to apply for some form of, I guess, subsidy and deferral in regards to rent and leases. Now they're measuring this based on, and again it's fairly new, but they're measuring it based on the drop in turnover. So questions that come up straight away is, how do you prove that? You know, if I'm a landlord and I'm getting someone to ask me to give them relief, I'm going to want to understand that they've dropped it. And there's been nothing to say how this occurs. You know, and if I'm a tenant and I've got no income, of course I need relief. So this has been happening already before they've come out. The government did encourage a couple of weeks ago that you start talking to landlords and let's get these conversations up. They did allow the banks to give commercial property loan relief as well, or deferral. So this has already been happening. We've found quite a lot of success. People get it. If you're in a shopping centre, you might need to get in line. But reality is, this isn't, whilst the legislation was more formalised yesterday, this has been occurring in a big way in the last 2 weeks. Once you do show that you qualify and you can talk about the level that you've dropped in turnover, it's meant to be the support in the same ratio as your turnover drop. Okay, so for instance, say you drop 50%, then the relief on the rent should be 50%. If gone further and said at least 50% of that drop has to be a waiver. Okay, nearly everything else has been a deferral. This one is a waiver, and they're saying the landlord can't claim it via bank guarantees or deposits. They can't do it via fees and interest and penalties. They really just need to waive that amount, okay, which is effectively they're passing on bank relief they've been getting. You know, we've got clients that are landlords in a big way as well, and some of them don't have a lot of debt. So in their case, they are literally carrying the load there. But it's about all pitch in and try and get through this, I think is the key message.
And is there any tax relief down the line for those landlords who have waived, half their rent?
Well, they won't be declaring that rent. So but there's nothing further in the stimulus for that. So yeah, there are plenty of landlords that, once they get it, it will be quite an impact to them.
Yeah, because a lot of landlords aren't carrying on a business, so they're not eligible for JobKeeper.
Right.
They're just receiving income. It's just not business income.
Yeah.
Now, my understanding too is that the state governments now have to legislate further details for that to happen.
Because the Tenancy Acts are state-based.
Right.
So the National Cabinet has come out, and the National Cabinet you would have seen in the news a lot lately. They've come out with the general overarching rules. Then the state-based they've come out. What we're seeing in practice, and it's a real, I think it's a good approach, is that whatever forgiveness is being done, apart from that waiver section, but on the rest of the deferment, so after the 50% in the waiver, or at least 50%, the rest is then asked to be deferred for 6 months, okay? So on that deferment, a lot of landlords are saying, well, I'll extend your lease by 6 months, or some are saying I'll incorporate that deferment into the remaining payments of your lease. Others have said, let's talk about extending your lease further than that, so if it's a place you want to be in. So it's getting good conversation. The main thing is that it is now formalised, and landlords have to come to the table, where there was some kickback, a little while ago, but generally the theory is there that everyone wears a bit. There's also a freeze on rent for the next 6 months. They can't increase rental premiums. And the landlord, as we said before, cannot terminate the lease within the next 6 month period either for lack of paying rent. So that one is, again, there's a lot of fact sheets that have come out the last few days. It's a big one. And like most businesses, your biggest costs are labour, product and space. So we need to look at this one and build that again into your cash flow as to what you can afford, noting full well that someone's taken a hit here. So the idea is if you can pay your rent, you still pay it. Okay. Anything further on that one? Okay, banks and funding. So a lot of people would have heard the government say, they've put a lot of money, made it available to banks and non-banking lending institutions. That is the case. I don't know if you've dealt with a bank the last 2 weeks, but it is very time consuming. The key one is the deferral of principal and interest repayments for up to 6 months. Some banks are starting with 3 months and then monitoring it and then saying we'll extend it for 3, but it is up to 6 months. This goes into term debt, so basically bank loans. It goes into equipment finance, Obviously doesn't apply to overdrafts. And also a little loophole, it doesn't apply to commercial bills. So you just need to look and understand what type of funding you do have. Now the key thing I say here, it's not total relief, it is deferment. The interest will be capitalised, okay? So it'll still add into your growing balance, all right? Some banks are sitting there and saying, well, let's extend by another 6 months, so we absorb that. Others are saying we'll absorb it in the remainder of the term of the loan. So it's really a conversation you've got to have. If you haven't jumped on this, do it yesterday. Like you need to, because it's not happening too quickly either. You need to register your interest and get in with your banker. The other side of it is extra funding. So the government came out and said they will guarantee up to 50% with a maximum of $250,000 on unsecured loans aimed at business to keep surviving. So if we're talking about that funding gap for the JobKeeper, these are some of the things you might access, okay? Now, it's not like they're giving away money. It's still the bank's money. The bank is still going through an assessment criteria. So they're going to want to look at how they get their money back. That's why your planning comes into play as well. But they are relaxing a lot of the rules. APRA have relaxed the banking requirements and their accessibility. So we are looking pretty favourably on banks handing out money. It's just, you've got to get in the line. You can imagine how many people have approached the bank. So if you haven't, you need to have your plan and get in touch with the banks. Look, the loans for the $250,000, they're 3-year loans with a payment, no repayment, a repayment holiday effectively for the first 6 months, okay? After that, they will roll out to be repaid within 3 years, or if you incorporate into something else. As I said, they are assessing you still, so you can't just walk up and expect just to be approved straight off the bat. But it is something you'll really need to look at to fund that gap and to fund your other rest of your business or livelihood for the foreseeable future. The final one we had to cover here before we take questions is around cash flow. Okay, we've mentioned a lot. All I'll say here is cash is king. If you haven't got a proper cash flow statement in place, you need to, a cash flow model. You know, a lot of the time we look at our profit and loss. Hopefully you look at your balance sheet, etc., to see how your business is going. At the moment, all you need to be looking at is cash flow. What's coming in, what's going out. If you haven't got something, get it into play. Get advice. You know, drop us a line. But this is going to be your best friend for now, for the next 6 months, absolutely. But also for after we get out of this sort of lockdown period, so we get back up and trade. Because, as I said before, a lot of this is deferment. So you're going to need to look and say, how do I manage all these payments later when I might have, you know, larger bank payments, when I might have larger rental payments, etc. This is going to be your best friend. So I won't spend too much time on that. That's really the point we wanted to make. The most content we want to cover is the stimulus, which I think we have. I think now we're going into some questions. I'll work out how to get this thing up.
So Scott, did you want to direct the questions?
So someone's asked, if I don't have any income from my business, how will I afford to pay my 3 casual workers $4,500 a fortnight? I guess I'll take the start on this, Darren, then you jump in. You know, like, you don't have to keep people on. That's the thing we've got to keep reiterating there. It's not mandatory that you have to keep people on, okay? So if you choose to keep the people on and make sure they get this $1,500, yes, you do have to fund it for a month. It is hard. So I would say straight away, if you've got no other sources, you need to go and approach the banks. Noting full well, when we talk cash flow, if you haven't done this already, pull out your bank statements, pull out your P&L, go through and work out what can you turn off, what can you go and negotiate terms on, what can you get some relief from. You need to save cash here. We're talking to clients about keeping a cash war chest to get through this, okay? Get some advice. Yes, it might sound funny, an accountant saying pay for some advice and we're trying to save cash, but I can tell you, you need it. Now's not the time not to get advice. You need to find a way to get this. So I would say the obvious one there is we really need to look at whether you need to keep the people on. And I know this gets in the emotional part, you've got good people, etc. But this is about survival. You do also need to look at how we fund it, and that's where the bank could be a good option.
And in that example, you will get the $4,500 back. So it's just the timing thing that you've got to manage.
Another is, can you pay the JobKeeper weekly?
Yes, you can. The legislation is framed in fortnightly periods, but you can pay it weekly. If your payroll is monthly, you can pay it monthly and then reasonably allocate that to the fortnightly periods. But paying at least fortnightly is sort of consistent with the rules.
Someone's asked about sole traders. So you want to take that one?
Yeah.
No employees?
Yeah, so sole traders will get the JobKeeper payment if they show the decrease in turnover. And that's for sole traders who are actual sole traders, like a person who's trading in their own name. For companies, as we mentioned before, they can nominate one person to receive a payment. Same for a partnership and same for a trust, they can nominate one person. So they'll be eligible for JobKeeper provided they can show the decrease. If they have employees, they will get it as a sole trader and the employees will be entitled as well.
There's a few questions here about if I'm a sole trader and I'm a casual part-time employee, and other ones where I work casual in one role and casual in another role. So I think that comes back to you will qualify if you can show the drop, but only once.
You'll probably get it for the sole trader and the casual jobs. It's dependent on whether you've been there for 12 months or more, but you'll only get one JobKeeper payment from one source. You can't get multiple.
Can I just ask on that, if your pay cycle, your fortnightly pay cycle finished on Sunday just gone and the legislation wasn't passed, so you've paid a normal payroll, what happens there when you're actually 1 week into April?
Yeah, I think that, but again, this hasn't been stated. It's more a practical viewpoint. We've discussed this. I mean, if they were more than the 1,500, you know, that's whether you want to claw that money back, I guess. But reality is you've met your obligations. If they're below the 1,500, our thoughts are you're going to have to top them up. I've read that the cash flow bonus is that you still pay your BAS or IAS in full, but the ATO will refund the PYG withholding portion to your BAS account, not to bank.
You won't pay the BAS. The whole idea is that you'll get a credit in the BAS. So you'll still fill out the figures in the BAS, but you'll get a credit and you won't actually have to pay it. So you won't pay it, but if you do pay it, they will refund it with the credit.
Still need to lodge and have that up to date.
Yeah, but it won't go to your bank account if there's a GST liability in the BAS, but it will if that ends up being a refund on that BAS. They won't unduly hold it in that case. But normally, if you owe GST, you'll still pay the GST.
There's a fair few questions in here about asking people to take annual leave, etc. Is it legal to? We might leave those ones. I believe you've got a HR one in the coming weeks. It is, you know, really a specialist advice around HR. They're learning this as well. What I will say is everything we've read says that there's no reason you can't use the JobKeeper payment to pay annual leave.
Yeah, that's right.
Okay. The hard part is what then constitutes annual leave and what it reduces by if they're paid, say, more than the 1,500. So that's a bit of a watch this space.
And where the moral obligation is, if somebody's entitled to leave and they're using up their entitlements, but you're getting a JobKeeper payment, should you be giving them the JobKeeper payment on top of the leave? And that's more of a commercial decision that you've got to make, because the way the law is written, if they're getting more than 1,500 a fortnight and it is annual leave, you don't have to pay them more. But I would think that's a bit unfair if you're going to have to pay them the leave anyway.
There's a good one here, Darren. An employee signed a contract in Feb, but didn't start till the 2nd of March. Does she qualify for JobKeeper?
The point in time is when you were employed and when was that employment effective. There's a pretty clear example on the Q&A. If you weren't employed on the 1st of March, the answer is no, you don't qualify. So it's a legal question of when were you employed. Generally, the first information that the ATO will have is when you lodge the employment declaration and what you put down as the start date on that.
What if an employee who I pay the JobKeeper leaves my employment in 4 months? Will I receive a refund?
No.
Yeah, you'll be getting reimbursed for the period they're there.
That's right.
And
so
then
money in, money out. Yep.
Yeah, after they leave your employment, they will no longer be in your records either. So it'll take care of itself. Do I have to pay all employees from STP, or can I nominate the employees I want?
Yeah, under this scheme, employees qualify 1st of March, still employed, all of those criteria. But the next bit of the rules that we've seen say you then have to decide whether you're making the payment to them or not. You don't have to engage with them, you don't have to make the payment. You only get the JobKeeper payment if you make the payment. If you don't make the payment, you don't get the JobKeeper payment. If you don't pay them the $1,500, you don't get the JobKeeper payment. And you may choose to do that in some circumstances.
How will this work with practices operating with a service entity? Look, it should be fine depending on where they're employed from.
Yep.
So it's about the payroll records. You know, we work with a lot of pharmacists, for instance, they have service entities. This will be looked at as a business. So it's where they're employed from.
Yep.
That hasn't been actually addressed in the rules as it stands now, but that would be a practical approach. So it's about payroll. If I pay employee $2,000 per fortnight, will the government still pay $1,500 and employer will pay the gap of $500?
Effectively, yes, that's right. But the super on that will still be on the $2,000. So you're effectively only out of pocket $500 a fortnight for that employee.
For the self-employed not using single touch payroll in any form, how do we get our back pay organised? Good question.
If you're a sole trader and you do have employees, then you should be on single touch payroll. It's only very, very micro, closely held employers who shouldn't be on it at the moment. They don't have to start till 1 July this year. And if you're a sole trader with no employees, then there's a registration process for you and you will get the payment directly.
This one is, I have staff that have chosen to self-isolate. They want the JobKeeper, but I have to employ a casual to do their job. Do they qualify? Do I have to pay them? This is starting to get in the commercial side of things. So with, I guess, this aspect, reality is this comes down to what your plan is. You know, this again is probably getting a more employment law than what we're talking about here. If you choose not to pay them, remember we said it's not mandatory. So if they choose to apply this and they're stood down, or careful with that term, and they're not on payroll records, they won't qualify. Likewise, if the casual is only new to you after the 1st of March, they won't qualify either under your employment.
Yeah. So they might be eligible employees, but there's a nomination process. You choose who you accept the nomination for and you register, and you move on from there. But if you don't pay them, they don't get it. So it's your choice.
Darren, this one's for you. Can you please clarify if you can do the JobKeeper for trainees instead of the apprenticeship or trainee stimulus, as the JobKeeper is more and covers 75% of the wage?
I've not seen anything that says that you can't do both. As far as I'm aware, they're independent schemes that you can get.
That one's probably more an employment law. Okay, good one. This one's where we're saying about the alternate test. I bought a business last November. Can I use profit and loss statement under the previous owner to prove the changes that have occurred?
This is where we're waiting for guidance from the ATO, because there will be new businesses who weren't in place a year ago who will have suffered a decrease in turnover, and until we see what the ATO guidance and the mechanism is, but they've left that with the ATO to determine what that is. There should be some guidance, whether it's rulings or some sort of legislative instrument that they issue to determine that. We don't have that answer yet.
This one's, I have an employee who earns about $250 per fortnight, has been with us for 18 months but hadn't worked the hours in March but has in early April. Would they be eligible? My take on this is where it's not so much the hours they've worked since March 1, it's more about have you paid them? So you would have to go and pay them for March.
Yeah. Were they employed at the 1st of March? And how much have they been paid? Then if you want the JobKeeper payment for them post 30th of March, you've got to pay them $1,500 a fortnight.
Do you have to pay $1,500 to your employees that usually earn less than that amount if you don't apply for the JobKeeper payment? Well, no. That's just normal business.
Yeah.
So. We might get a couple more in, and then I'll refer to an email you can go to just for questions that aren't answered, or if you've got more specific stuff, guys, about your particular affairs. How about if we employ new people now? Do we get the reimbursements?
No.
Maybe just reiterate. There's a few here about that 30% decrease. How will it be assessed? You might just want to cover that off again.
Yeah. So it's based on your GST turnover, as I mentioned before, So you look, your first point of call is to look at the same time last year, assuming your business is continuing from last year. So you're looking for a drop. If it hasn't dropped and there's other things like you expanded or you took on a new business or your business is seasonal, then we're waiting for more detailed guidance on how you measure that turnover. But the ordinary run-of-the-mill turnover test, that's the prima facie test, is if you're a March monthly lodger, you look at March this year compared to March last year, and April this year compared to April last year. If you're a quarterly lodger, then you look at April to June this year compared to April to June last year. And that's how you're measuring it. But you do it on projected turnover, so that's where your cash flow is king, is that you're looking at what's your projected revenue, and that's how you're first of all self-assessing that your turnover has dropped. Then you'll have to measure the actual turnover to see if that's the case.
Probably the last couple here is, I read that you shouldn't lodge your BAS until the due date. Is that right? I think the view of the world here is you need to do your planning and work out what your BAS will actually say, because it could be getting you a refund. If it's getting you a refund, you want to bring that forward. You know, if it's so you need to actually do your analysis and then make that call yourself.
But just keep in mind that the cash flow boost, if there is a credit, it will not be paid until the 28th of April, even if you lodge your BAS today. You'll have to wait. They will not make any payments until that date. And likewise with the JobKeeper, no matter how efficient you are at registering and reporting, the payments will not come out until May, and then thereafter within 14 days of lodgement of the paperwork.
Yeah, and probably the final one here is just to clarify, the $1,500 is a gross payment. Yes, it is a gross payment. Tax will need to be paid on that, and to the employer will need to be withheld. So you need to make sure that you're getting your payroll right around that too, because you will only be reimbursed the $1,500.
Yeah, and then factor in the cash flow boost and the pay-as-you-go withholding if your turnover is less than the 50 million.
Guys, as I said, there's a lot in this. It's changing every day. We're trying to keep up with it. It's been quite the task. We know there's still quite a few questions here that aren't answered. And again, some of these are more HR and legal related questions, so we'll try to steer clear from that. You need practical application, so I can't stress enough. Get your cash flow done. Get your planning done. Don't just think about tomorrow. Don't just think about the 6 months. Think well beyond that, and you need to stay pretty agile. We've put an email on screen now, covid19@pkf.com.au. We are putting alerts out every day that are pretty comprehensive and fairly easy to understand. If you want to get those alerts, please let us know via that email. If you have more specific questions, you can either use that or contact Darren or I. I'll be more than happy to at least try and point you in the right direction or touch base. It is evolving, as we've said. And you need to keep on top of this, because it could be the difference between not only surviving but prospering later on too. So thank you for your time.
And thank you, Darren and Andrew, for your expertise in this matter. It's been absolutely fantastic tonight. So thank you for your contribution. I just wanted to also remind everyone that next Thursday, the 16th of April, as Andrew has alluded to and Darren, we have another webinar on HR and your responsibilities in the workplace. So make sure you get onto our site and register for that as well. So thank you so much for your time tonight. We really appreciate it.
No, pleasure. And good luck. Stay safe.
Thank you.